Hello, and welcome to Virtual Investor Conferences. My name is John Viglotti, and on behalf of OTC Markets, we're very pleased you joined us for our next live presentation from VersaBank. Please note you can submit questions for the presenter in the box to the left of the slides. And you can also view their availability for one-on-one meetings through the Schedule Meetings tab found on the conference platform. At this point, I'm very pleased to welcome David Taylor. He's the president and chief executive officer of VersaBank, which trades on Nasdaq and the TSX under the symbol VBNK. Welcome, David.
Well, thank you. I'm very pleased to be here to tell you about the technology-based, fully digital, branchless, business-to-business bank that I created about 30 years ago. Perhaps has one of the lowest risk profiles of any bank in the industry. There's the advisory. So I had the opportunity to create a bank from virtually a whiteboard. I did away with all those risks that plagued other banks and still do plague other banks. So, for example, taking on unnecessary risk, loan losses and collections, and the need to have a lot of people, deposit risk, i.e., what we've seen recently, the run on the bank sort of thing, economic exposures and down cycles that we might be seeing right around now, interest rate risk, and inefficiencies. So the bank you see today, VersaBank, is virtually what I created from a whiteboard back in 1993. So it's a fully digital bank that is able to operate throughout North America. It's a cloud-based bank. It has tremendous operating leverage, as you'd expect, being a software-based bank. Software we actually created ourselves, because back in 1993, the banks were run by mainframes. And I thought the time was right to create a bank that could operate from a PC. And utilizing telephone modems, it seems like like archaic now, create a digital branchless bank. Now, from an investor perspective, if you have a look at our track record, you're going to see a significant increase in earnings over the last while, as you'd expect as a digital bank that with tremendous operating leverage it starts to come of age. It's poised for tremendous growth, I think, because we're hopeful to soon have access to the full North American market. Presently, we have a federal bank license in Canada, but we've been applying and working with the U.S. regulators to have access to the U.S. market. And I publicly stated that we're hopeful by the end of this autumn that will become a reality. There's also a free option with our bank in that to guard against the onslaught of cyber criminals that digital banks are vulnerable to, we decided to create our own cybersecurity firm, DRT Cyber, that keeps our bank safe from cyber attacks and also many high-value enterprises in the United States, such as railway lines and retailers and police departments and other enterprises that are benefiting from our cybersecurity firm. So when I say it's a business-to-business model, that's exactly what I mean. We don't have any direct interface with our depositors or our borrowers. The bank's operated from two tech facilities, one located in the middle of Canada in Saskatoon at the Innovation Centre at the university, and the other in London, Ontario, actually at the airport to give us easy access to air travel. Our partners on both sides interact with our customers and gather deposits for us on the deposit side, and on the lending side, we have partners that do the very same thing, giving us access to loans. You might think of our bank as an electronic warehouse that warehouses deposits that are sent to us electronically from our deposit partners, and loans it warehouses that are sent to us electronically from our lending partners. Earlier on, I said a very low risk model, and again, having the opportunity to design a bank from scratch, I didn't think it was appropriate for a small bank to accept much risk, and so I did everything possible to mitigate the risks that banks are normally exposed to, and that being credit risk, for example, and liquidity risk. On the credit risk side, you can see that's a graph that shows our provisions for losses, and concern we really haven't had any material losses in our 3 decades of existence. That our provisions for losses are just rounding errors, a few basis points up, a few basis points down. So that sort of illustrates what I was talking about, not taking on very much credit risk. Moving right along, and here's a nice graph, very nice graph. It shows the operating leverage coming into effect, where our fixed costs are remaining sort of stable around 50 million. Our revenues are increasing somewhat exponentially as our loan portfolio is growing, giving rise to a very rapid increase in profitability. Number 8, this slide shows, again, what I was talking about. As our assets got to about 4 billion, that was the end of the third quarter, loan portfolio approximately 3.7 billion. That was a 30% loan growth year over year, gave rise to a 37% revenue growth, translated through to 83% net income growth, and even more in EPS, in that we had the opportunity to buy back some of our shares when we thought they were undervalued over the last while. So year over year, we're looking at 96% growth in EPS. As the operating leverage is being felt now, it gives rise to a statistic that analysts like to look at with banks, and that's the cost to earn $1 of revenue. And in our case, we're the third quarter at 43 cents to earn $1 of revenue. It's one of the best in the industry. And ROE, of course, is increasing quite dramatically as our equity is deployed into interest-earning loans. So how are we going to grow going forward? Loan growth in our usual way, the tried and true way here in Canada, through our point of sale program. And hopefully, as I was saying earlier, hopefully by the time autumn's over, we'll be blessed with the ability to expand our point of sale program into the United States, which for us is somewhat seamless of an endeavor, in that we are a cloud-based bank. In fact, our data's with Microsoft in the United States already. So it's a very easy thing for us to do to expand our banking business into the U.S. In fact, we can operate our bank functionally from anywhere in the world, being a cloud-based bank. But the jurisdiction that we're able to operate in is dictated by the regulation in that particular jurisdiction. We're always looking for economically priced deposits. Of course, that's the lifeblood of any bank, and we use this digital branchless model to access to deposits that are relatively cheap and sticky. And you might see us have a look at some accretive acquisitions going forward, although at this point in time, our dance card's sort of full with all the opportunities that we see with our point of sale program. Moving right along here, slide 10 just gives you an idea of the size of the U.S. market that we're keenly interested in servicing. We already have some business in the States that we decided to try it out and prove out our concept that our digital model would work well in the States. So we actually have some customers, some operations presently, but it might be that the U.S. market is about 100 times bigger than the Canadian market. Some people estimate it at 1.8 trillion. Fantastic, and it appears that the new mousetrap we're bringing to the U.S. market is without peers. Moving along. So we're looking to acquire a very small U.S. bank, but this bank has an OCC license, a federal license, and it just works wonderfully for us. In fact, it's very similar to how I started the bank in the first place, by acquiring a tiny wee financial institution in Saskatchewan to model out this new concept I had for B2B digital banking, so that our Canadian regulators could see an actual functioning financial institution based on this new model. At that point, of course, at that point in time, financial institutions operate through branch networks. So this is actually very similar to what I used in Canada, and was able to convince the regulators to give me the first federal Canadian bank license had been granted in 18 years at that time. That was August 1st, 2002. This slide that I just flipped to, slide 12, again, wonderful graph that shows the efficiency of the bank, or the cost to earn a dollar of revenue, plummeting as we're scaling up. Roughly, our target's at $4 billion in assets, which we've just punched through. Of course, we were at $4 billion last quarter. Gives rise to, this is the math, gives rise to 42 cents to earn a dollar of revenue and an ROE of 14%. And if you expand that to $5 billion, the math just results in less than 35 cents to earn a dollar of revenue and an ROE of something better than 20%. So, clearly we're at an inflection point now where we're taking full advantage of the offering leverage that our bank has. This slide tells you about DRT Cyber, that cybersecurity firm I told you we created to first and foremost keep our bank safe. But being the entrepreneurs that we are, we thought, why not help out other enterprises that can't afford to be attacked by the cyber criminals of the world? And it's grown. As I was saying, it provides this type of service to a lot of well-known U.S. corporations, Canadian corporations. We had about 400 clients across North America, and we're hoping to expand this business a lot more, in that we feel we have state-of-the-art cybersecurity techniques and software that we've developed in-house to keep our clients safe from the inevitable onslaught of those criminals. So, as investors, why would you want to invest in this little bank? Well, I guess one reason is a little bank, so it's able to bob and weave and take advantage of opportunities in the marketplace that the large monolithic banks don't have that ability to do. So our relatively smaller size is indeed our strength. And we're at that inflection point where finally the software that we developed and the customer channels that we put in place is starting to pay off in a very big way. The acquisition of that little bank in the United States gives us access to maybe the largest point of sale market in the entire world. And here we're bringing a proven product from Canada to help our soon-to-be customers in the United States do a little better with their point of sale financing business. If you don't like risk, I don't like risk. It's a highly risk mitigated model. There's no branch network to be vulnerable to a run on the bank like you've seen in recent times. In fact, there isn't even a fancy website where depositors can pull their money out in an afternoon and move somewhere else. Our deposits are term deposit receipts, i.e. they're locked in for the term. So the vulnerabilities that other banks have felt with respect to runs, liquidity issues, I modeled out of the original concept for our bank to avoid those types of issues that have plagued the industry. Valuation, well, we're sort of caught in a waterfall that all the banks seem to be caught in. Mind you, we don't have any of the characteristics of the other banks in the industry, and our stock is trading well below book value. But that's what's given us the opportunity to buy our stock back and make that dramatic increase to EPS I was talking about earlier. And you get that cybersecurity firm that's a wholly owned subsidiary of the bank, basically for less than free. It's not valued at all in the stock market valuation, given our stock is trading at less than book. So that's it, and thank you very much for your attention. I always look forward to these presentations, telling you about our little VersaBank, and I'm very pleased to open it up for your questions.
And David, we've had a number of questions already come in, so I'm going to take these in an order that makes sense intuitively to some degree. How were you impacted by rising interest rates over the past year or so?
Well, actually, we were somewhat insulated from the rise or fall in interest rates in that we keep a very closely matched book. Assets matching liabilities, duration of both are. We try to get it to be zero gap, but we're moving around a little bit. So when you're so tightly matched, it doesn't really matter if rates go up or down. You still earn your net interest, the same net interest margin. Now, mind you, if rates went higher and higher and higher, as pretty everybody knows, it puts a damper on banking business, and then the volume of new loans that we put on would eventually be slowed down by an ultra-high interest rate. We haven't seen it really get to that level, so it hasn't really dampened the deal flow. As of last quarter, we were up about 30% year over year, and could very well be that we're going to grow at 30% again for the upcoming year, all things being equal. Right now our budget says 20, but I think that's the answer. Haven't got the usual vulnerability that the banks you saw, unfortunately, in the news faced when they were not even close to being matched.
And David, when you say that 20 or 30%, that's referring just to the Canadian business if you are able to get approval for this acquisition in the U.S. and broadly launch that RPP program in the U.S., that you could see growth that would exceed that 20 to 30.
Yes, that's absolutely correct. Just in the Canadian market, we'd be looking about 20, 30% in the upcoming year, barring anything unforeseen. It's the run rate presently. The U.S. market is a huge market compared to the Canadian market, and as I was saying earlier, our new product, point of sale product, appears to be without peers in the United States. And from the sort of test marketing we've done the last couple of years, it looks extremely well received. So who knows the growth that we'll experience in the United States.
And is there any limit to that potential growth in the U.S.? Are you concerned about being limited by the deposits you're able to raise in the U.S. that might limit that trajectory?
Not on deposits. The advantage of being a small bank is that we're sort of a drop in the bucket in the deposit market, and the traditional deposit channels that we've already doing some work on. Hitching up to our bank look like they easily supply funding for us, as that channel does in Canada too. Eventually, a bank runs out of equity, and then it'd be necessary for a bank to raise a bit more equity to keep the growth going. And that's sort of standard for us, standard for all banks. I hope that's the case, because that means we're growing really rapidly. The faster we grow, the more revenue we earn. The more revenue we earn, the more earnings per share we earn. So eventually the constraint is the equity that the bank has. No, we're generating equity at approximately $1 million a week right now. So we can internally generate a lot of equity, but it might be in the United States that the growth potentially outstrips our internal generation of equity, and that way then we go back to the market to raise some more common equity.
And David, what's the margin profile look like in the U.S. relative to Canada?
It's slightly better than Canada. In Canada, we're seeing around 270 odd basis point net interest margin. And that's, by the way, that's the widest net interest margin of any, at least publicly listed financial institution. Not sure what the private ones do, but I doubt they do that. That's sort of a high watermark for a bank's net interest margin. The U.S. market, because the way the deposits are a little bit cheaper vis-a-vis the risk-free rate, it looks to be wider than that. Sometimes when we have a look at it, it's about 100 basis points wider. But it's hard to say. From time to time, those things change. But it's always north of what we see in Canada. It might be 100 at sometimes, maybe 75 at others. So it's a more profitable market vis-a-vis the Canadian market.
So not only would you be getting the that higher operating leverage falling to the bottom line, but you've got the additional benefit of a slightly better margin there as well in the U.S.
Yes, indeed, it's all good. And the model that we proved out in Canada over the last decade, and in the last 2 years through our Versa Finance company, proved out in the States, looks ideally suited. The customers, or the potential customers we talked to in the States, are bearing that out with their enthusiasm to sign up with us.
So on that, David, could you just go over again, because I think it's relatively straightforward, but go over again the path and strategy for entering the U.S. market, and the timing that you're thinking about right now with respect to when you expect to hear back from the regulators, and if that would be a positive in the time frame you're expecting, when you could be operating in the U.S. on a widespread basis, because you're basically operating in the U.S. now on a limited basis. But when would you be able to really light that program up?
Well, if we receive a positive response from the U.S. regulators prior to the end of autumn, then we'd look to close early in the new year. So that'd be in January sometime. And with that closing, that gives us the ability to raise deposits in the United States and to lend throughout the entire country. So that'd be early in the new year. I would expect to close, and then we would be free to operate as a bank in the United States throughout the entire country, and that'd be tremendous. Presently, we're operating as a finance company in the United States, and that was more just a proof of concept, but we were able to prove the concept. So that's the time frame, and we got our fingers crossed that winter doesn't appear, and we haven't received that positive response. But that's how the time frame would unfold.
Now, with respect to the time frame, a question from somebody who's obviously been watching, because they know the U.S. acquisition was supposed to initially close somewhere around a year ago. What's held the decision up from our U.S. regulator?
Well, I think the U.S. regulator, quite rightly, has been looking very, very carefully at its existing banking clients. And our application would have received probably the increased degree of scrutiny that it should receive, given those failures. Because those were shocking failures. And I think I'm just guessing here. I don't know precisely what goes through the U.S. regulator mind, but if I had 5 banks fail with liquidity issues, I'd take a hard look at those that were requesting to enter the U.S. market, and that's likely what slowed it down. But from our perspective, take the time you want, U.S. regulator. We're not slowing down our growth in Canada, and our earnings are kind of reflecting that. And we do have the finance company operations already in the States. So we see our job to provide the U.S. regulator with all the comfort they need to know that VersaBank's somewhat impervious to those risks that they saw with the liquidity issues, the terrible mismatching and the access to demand deposits via a website. I mean, that's horrible. From a banker who's been around for 46 years, that's incredible to run a bank in that fashion. So it's a long way of answering, but I would say those shocking failures definitely, I think, cause U.S. regulator to take a harder look at things in our bank too.
Okay, we've got about 4 minutes left, and I think 3 or 4 questions that are still sitting here. So keep that in mind as you respond. How much of a discount is the bank currently trading to book, and what are the catalysts that could bring that discount? The question's in line with the market. The answer is probably more, where would you like to see the stock trading at relative to book?
Well, right now it's trading at 3/4 of book, 75% of book. That's incredible. A normal U.S. bank with the profitability trend that we have is usually around 2 times book. Our book value in U.S. dollars is about approximately $10. So it should quite rightly be in the $20 range to have normal profitability stats.
Excellent, thank you. You talked earlier about the acquisition that you're looking for in the U.S. You also talked about cybersecurity business. What's the trajectory for that cybersecurity business? And if you're growing in the banking side in the U.S., how do you think about the cybersecurity business?
Well, I think I'm remiss, and I didn't answer the first question completely. The catalysts, I think, are twofold. One is we're releasing our figures on October 31st year, and figures will be released on December 13th. So I look forward to talking to folks that are interested. So I think that'd be a catalyst. Folks, like to see banks' year-end numbers before plunging in. And the other thing, of course, is the green light to operate in North America as the catalyst. DRT Cyber is being kind of on the back burner, to tell you the truth. We've been concentrating on acquiring that U.S. bank license. It's grown, I think, 20-30% year over year, but I think DRT Cyber could grow a lot more than that. It's so I say it's got wonderful technology to keep high-value enterprises safe. Going forward, it probably, as I've done in the past with companies we've created and incubated, it'll be spun off, and it doesn't quite fit as a bank subsidiary, in that now it's growing larger and larger, and it has a very good business of its own. It's still, its best customer, of course, will always be VersaBank through a contract. But I think sometime in the future, like I've done in the past, DRT Cyber could be spun off, and then it's free to grow as rapidly as it should.
Excellent. One final question, David, and that is, what should a shareholder expect for dividends and buybacks going forward?
Well, I just love buying the stock back 3/4 of book value. I'm not sure we're going to have that opportunity going forward much longer, for those various reasons I just alluded to. But I love that. And if the stock presents itself at those bargain basement prices, we'll try and buy back as much as we can. A dividend's a good question. We pay about 10 cents per share dividend right now, and that's tiny little dividend. And at a normal payout rate, that'd be more like $1 a share. So that's a pretty healthy increase in dividend. But then again, we have these growth aspirations, and we like to retain capital to fuel the growth. So there's a little bit of a balance there, but there's a ton of room for increasing our dividend, and that our earnings have basically, well, on the run rate, are about double what they have been 12 months ago.
Fantastic, and that's the end of the question. So, a few parting words, David, and we'll let the group go.
Well, thank you very much, everybody, for your good questions and your attention and dialing in. Stay tuned on December 13th. I'll be back on the video talking about our year end, and we'll have open lines again. You can ask me follow-up questions. I don't get a whole lot of interaction with actual real humans, in that I created this digital bank without any real interface with people. So I do enjoy talking to people, even if it is on the video, or if you happen to be in Canada, come by and see us sometime in